I'm Carlton Sharp, pastor of Faith Christian Center Church, right here in Beaumont, Texas. And we're here on what's happening in our neighborhood. And today, my special guest is Mr. Michael Perez. Welcome back, Mike.
All right, good to be here.
Hey, tell us about who you work for, and really, that's how we're going to get into our conversation for today.
Well, I'm the business development manager for Gateway Mortgage Group, and we like to work with people, show them how to get into a house of their own. It's an American dream, and so we work with all kinds of people, helping them finance their home purchases.
So what is a business development manager? That's a big title, Mike.
That is. I do relationships. I have to constantly remind people I work very hard. I'm working even when I'm not working. I'm working all the time. People are always doubting whether I work, but I work very hard.
yeah, right. So Mike, so you're in the mortgage business. So
Yes.
How does someone who wants to buy a home prepare to buy a home?
Yeah, a lot of people, most people, they don't buy a home very often. Maybe only once in their lifetime, but even if they move around, maybe only 2 or 3 times, and things change over the years, and it's hard to keep up with, and it's a lot that's involved. And a lot of people don't understand the difference between what a realtor does and a mortgage lender. So there's a lot of moving pieces. But really one of the things you want to do first is, even before you start looking around, is to go to a mortgage company or your bank and find out whether you can get pre-approved.
Yeah.
Because there's a lot of things that you have to do that might take a little bit of time, that you have to set up. And so you want to get into that game early, so that you can see that path forward. And we have clients, that come in and they buy a house 2 or 3 years later. And we don't mind keeping up with them for 2 or 3 years. We prefer they come in early so we can show them what they need to be doing to prepare.
So do you have a list of things that, like step 1, 2, 3, 4, 5 of
Well,
things?
it's different for everybody, and so there's a lot of things to keep in mind. We do, tell people, you need to save some money. You need to get it into the bank. If you have it in your mattress, it's not going to work. If you can't bring cash to closing.
Right.
So the Fannie Mae wants to make sure that money is actually yours. So you got to get that money to your account at least 2 to 3 months before you go to closing. Otherwise, you have a lot of explaining to do.
Wow.
So that's a big one. Working on credit, is also another big one. Income, especially in this area, you have to document your income. Now, if you have a salary or wage position where you work 40 hours a week, that's real easy.
Yeah, but if you have a personal business,
if you're self-employed, if you do shift work, if you make overtime, if you make commission, and in our area, a lot of people do that.
Yes.
And what a lot of people do also is they might work for 4 or 5 different companies in 1 year because they're working contracts, they're doing construction, out the plants. And so, it's nothing for them to change jobs, because they're working a job, not necessarily long-term employment. And there's plenty of work, but so there's documentation you need to gather. And we're real mindful of that, and we're real good at explaining that to underwriters. But, we got to work with you, and sometimes we got to explain it. And one thing to remember is that if you, whatever you do, if it's not like a regular salary or regular job, you might need a 2-year history of doing that.
Okay, that's
so
good.
if you're self-employed, you have to show your income over 2 years. Your commission, to count commission, you have to show a 2-year history. It doesn't have to be at the same job, but the fact that you've been able to, continuously and reliably bring that income in.
So now, are they asking for 20%? What is it going now? I mean, when the stock market crashed and all things broke loose, they changed the system, because it used to be you didn't have to have a lot of upfront money.
Things have changed a lot, but it's still you can get into a house for anywhere from 3 to 5% down.
Okay.
If it's going to be your primary residence, an FHA loan, which is a government guaranteed loan. For 3.5% is the down payment. 3% for conventional if it's if you're a first-time home buyer. Otherwise, it's 5%. But you can still get in pretty affordable.
Okay, so 3 to 5%.
Yeah,
and they need that in the bank.
Yeah.
So at least...
so let's talk about closing costs, because a lot of people
Yes.
get confused. What's a closing cost? And every kind of lender kind of looks at things differently. But I like to say that there are three costs to getting into a home and getting financing. First off, you have your transaction fees. Okay, so that's our financing fees. There's a lot of legal fees and title fees. Okay.
Yeah.
So really, the title company and your lender are really the ones to do the primary work, actually closing your home transaction. Okay. And so the title company is going to research and make sure that everything's right with the property, that the person who's selling it has the right to sell it to you.
Right.
Because the last thing you want is, you buy a house and 3 years later someone says, hey, this is my house.
That's my house.
And then they show you some documents and it really is their house, And so the title company not only looks all that up, but they provide what they call a title policy, which enables or ensures basically that they've done their work. And if something isn't right with their work and later on someone comes and makes a claim on your house, they have to pay you. The title company has to pay you if you have a title policy, what you're out. Now, so you have your transaction fees, okay? Now, those are all the costs of the transaction. Buying a home is a major legal transaction, okay? Then you have your down payment, which can be anywhere from 3 to 5% minimum. You can always put down more.
Right.
If you want, if you're buying a house, if you're moving out of one house and you've got a bunch of equity, you probably sell it and put a lot of that money into your new house. So you might put more, but your minimum is going to be somewhere between 3 and 5%. You also have your escrow or your prepaids. Okay. So if you have a mortgage and you have less than 20% equity, you put less than 20% down payment. Your mortgage company or your financer they're going to want to make sure that you're, paying your insurance and paying your taxes. They don't want the county putting a lien on the house that they've financed. Okay, so insurance and taxes work two different ways. Insurance you pay up front. Okay, now when you insure your car, you might pay by the month, or by the quarter, or half a year. For instance, I pay every 6 months, for my insurance. But when you buy house insurance, your financer is going to make sure they're going to say, no, you got to pay a full year up front.
Well, but wouldn't that be included in a person's escrow?
That's what I'm saying. So when you set up your escrow, you have to pay a full year's insurance up front. Then you don't have to pay your taxes because your taxes are paid in arrears. You pay them at the end of the year. But they're going to collect a buffer. It's about 2 to 3 months of a little bit of those taxes and a little bit additional insurance. So if something happens, they have that buffer. So that adds up to quite a bit. Now here's the deal. The seller is allowed to contribute towards some of those closing costs. For a conventional loan, they can contribute up to 3% of the sales price. For an FHA, up to 6%. But you have to negotiate that, because if you're buying a $100,000 house and you say, I'll give you $100,000, but I want you to chip in, $6,000 towards closing costs. Well, they're only making $94,000, and they still have to pay the realtors. The seller pays the realtors. And often,
another 6%.
Normally the seller pays for that title policy. Okay, so they can pay for the title policy plus a certain percent towards closing costs. All right, so you have to negotiate that. And on top of that, now what they may say is, well, you know what? You pay me $106,000 for the house, and I'll give you $6,000 towards closing costs. So you're kind of financing that into the sale of your house. The problem is, if the appraiser comes out, because the house has to appraise for the amount you're paying, if you're getting a loan, the financer is going to make sure that you're not spending $200,000 on a $100,000 home. That if it only appraises for 103, well then you can't give them 106.
And you're gonna have to come
so there's some moving parts. So that's negotiated. But the seller can contribute some money, okay, towards that. The other thing is, if you fall under a certain income bracket, you can get maybe a grant that can pay for some of that. Now, the seller cannot contribute towards your down payment. Only those transaction fees and your escrow setup. A grant can be used for anything. Okay.
Now, that's the first time I'm hearing about a grant, the possibility of getting a grant to help.
There are grant programs, and basically they kind of finance that. Normally get a little bit of a higher interest rate. Okay.
Yeah.
So they make it up on the long term, but if you don't have the money on the front end, you need to get into a home. It's worth it.
And now, is that one of the things that you talk about, getting the pre-approvals before you get into the process of purchasing your home?
Yeah, and that brings us into the credit score.
I was going to get there.
Now, first thing to remember is that unless someone pulls your credit for real, you don't know what it is. So, You know, you look these things up online. It might be fairly accurate or it might not. And your credit pool for a car or a house or something different is different. And pulling your credit, there's a different scoring system.
Okay.
And for a house, it's the most strict or most difficult scoring system. Okay. You need a 580 right now.
Okay.
To get into a house, but even at 580, it can be difficult. We have to get those run through Fannie Mae or Freddie Mac. That's a whole nother explanation there.
Yeah.
Okay.
Yeah.
And so the guidelines say 580 is enough, but it isn't always actually enough. 620 is a really good score.
Now, with that, people need to understand the lower their credit score is, the higher the interest rate is.
The rates can be.
Yeah.
Yes. So you really want to get to at least a 620 to be real confident you can get an FHA loan at least. 680 is kind of the point where you pretty much qualify for any kind of mortgage product. And people don't understand there are different kinds of mortgage products with different benefits and different different methods. So 680 is kind of that sweet spot. When you get to 720, above 720 doesn't really help you a whole lot. 720 is about as good as you need. And so a lot of those grant programs at 660, maybe 640, is the minimum. So somewhere in the 600s. And so that's where why you want to come in and look at what your options are and pull your credit.
So mid 600s to upper 600s are what you're looking for.
Yes.
And when they come in, you pull their credit report.
Well, they have to put in a loan application, which can be done online.
Right.
Okay. But they have to put in a loan application to allow us to pull their credit. And then when we pull it, we can see their credit history. And that's when we can say, hey, look, your score is a 560 right now, but there's quite a few things that you could do. And so that's one of the difficult things about credit, because financial responsibility doesn't always lead to good credit, and vice versa. So you have to really understand what's going on. Now, if you have, late payments are a real big credit killer.
Right. Right.
And late payments, collection accounts. There's not a whole lot you can do about that other than pay off those collection accounts or wait for time to pass, for those things to kind of roll off your credit report. Not a whole lot you can do about those things. But there are some other things. A lot of people have no credit. Not bad credit, just no credit.
Yeah.
They haven't used lines of credit in the past. And, that's for financial responsibility, that's good.
Yeah, they got the money under the mattress.
They got the money under the mattress. No debt is good. That's responsible. It's not good for your credit because you don't have a history. You can't show you have a history of making payments. So you need some lines of credit. And there's two kinds. There's installment, that's your car, furniture loan, you finance something, you're just slowly paying it off. Revolving is your credit cards.
Right.
The amount you owe ebbs and flows depending on how much you charge, and you're paying that off. Now, when you get a new line of credit, as soon as you get a new line of credit, that hurts your credit. So when someone is getting ready to buy a house, saying, this is all you're doing. Don't apply for anything else.
And that's good for people to understand this, because when they go to the department stores and things like that, and they say, well, hey, you want to fill out a new credit application and stuff like that, that can actually hurt.
It can. At first,
correct.
If you open that line of credit, then after 3 or 4 months, it starts helping your credit.
Right.
Because that's a new piece of history that they can look at to say, okay, they're making their payments.
But if you're about to buy a home,
you don't do what you're about to.
You don't want.
Now, if you want to buy a home now and you have no credit, well, you don't have a choice.
Right.
You're going to have to build some credit, And so, now, here's another thing, okay? Your credit score depends a lot on how much of your credit limit you're using. Okay?
That's
so
good.
If you have a credit card with a $300 credit limit and you go make a $200 purchase, you're using over half your credit limit on that card. That's bad. Okay? If you have a credit card with a $10,000 credit limit and you go make a $4,000 purchase, you're great. Because you're only using 40% of your credit limit. So the difference between owing $200 and $4,000 is pretty enormous. It's not the debt.
It's the amount that you have left.
It's the amount that you have left that you have the ability to borrow. So, that's one thing to keep in mind, especially if you're, just opening up a credit card. You're going to have a small credit limit. So, what I encourage people to do is, open a credit card, fill up one tank of gas a month.
Yeah. Pay it off.
Yeah, exactly.
Yeah.
You're just building that credit history. And, the good thing about having no credit is it's actually kind of easy to manipulate your credit score because you have a clean slate, and so, it's not really, the way things should happen, but that's the world we live in, and so that's how we have to figure it out. So, that's why another reason why it's important to apply for financing early, and you want to, there's lots of places online, and if you know what you're doing, great, you can save an eighth or a quarter of a percent, in your interest rate.
And I tell you what, that matters.
Yeah.
In your monthly payment. I mean, that quarter percent of interest.
An eighth of a percent or 4% actually doesn't add up a whole lot. It can add up over time, a fair amount, but you're really looking at maybe like a half to a full percent before you really have a big difference. But it doesn't matter how low a rate you get. If your loan doesn't close,
you still are out of house.
It doesn't work. So you want a professional who can guide you and is looking over your loan and making sure it closes. And it takes, time to close. Okay, because you have to order an appraisal. You have to do all these things that take time. Also, our government, who's looking out for us, got our back. They put in certain waiting periods.
Right. Right.
So after we get everything set, for instance, we have to wait 3 days before you close, give you a chance to change your mind.
Because once you sign that paper,
exactly,
it's yours to keep.
Exactly. So there's a lot of time and a lot of moving parts that go into closing on.
Okay, Mike, I'm finna throw a wrench in this thing. Okay. So that's buying a home from a seller.
Yes.
What happens if I have land and I want to build my own home on my land?
Yeah.
Let's talk about that.
Okay, so normally how that happens is you get a construction loan, which is really just a short-term loan, okay? And you get the money to build your house, and whoever gives you the money normally gives you a certain amount of time. You have this money for a year. It's an adjustable rate loan, basically. Then, once the house is finished, you get a regular mortgage to pay off the first loan, okay? Now, as a mortgage company, we only do mortgage loans, so we can't do short-term loans, but we have what we call a single close product. So instead of paying closing costs for this loan and the construction loan, and then closing costs for your mortgage when you pay off the first loan, we do single close. You only close once, so only one set of closing costs. Okay, so we give you a short-term loan, and then it modifies. So there's a small modification fee, and you qualify for your mortgage at the very beginning. Now, if something changes, then you might get stuck in that adjustable rate loan until you can bring your credit score back up. So then you build your house and it modifies into a mortgage. So you save a lot of money doing that way because you don't pay your closing costs twice. Now you can use this product not just for building a house, new construction, but you can use it for buying a house that needs some major remodeling. Okay? So like right now there's some houses that on the market that were flooded. They've been gutted, but they need, might pay $30,000 for it, but you need to put $100,000, into the house. You can't get like a little remodel mortgage for that because there's going to be a limit on how much, money you can spend. So you can use a construction product to completely refab that house and bring it up to speed.
Now, okay, so now let's ask this question. What's the difference between a mortgage company and a realtor?
Okay.
Yeah.
So here's the deal, and a lot of people think they don't need realtors now.
Right.
But you may not need a realtor to find your house. You can go online, you can find it. But a realtor, first off, has access to all these properties. Your realtor handles the negotiation and the contract. Okay. Now, here's a caveat.
Disclaimer.
Disclaimer. Some realtors may disagree with my view of what they do, but those are the two big things. They handle that negotiation. You're negotiating for closing costs. They're guiding you what you can offer. A good realtor is going to be able to tell you, you can't, this house isn't worth that much, and it's not going to appraise. So they'll be able to guide you a lot on those things. And man, those contracts aren't pretty, so they earn their money there, okay? Your mortgage company is, handling your financing and really your closing. We're working with the title company.
Right.
Your realtor doesn't do a whole lot in closing your actual loan. Once they get that contract completely settled, and let me tell you, it can go back and forth many times.
Right.
Once they get, there's addendums and all these extra pages. Once they get all that set and they get it to us, your financer, and to the title company, they're for the most part done. Okay, then it's really comes to us and to the title company to close it, and there can be challenges. Okay, there's people get frustrated because we keep coming back and say, all right, now we need you to write a letter of explanation about this. The underwriter wants to see this. They want to see this document. Okay, there's a lot that goes in to that transaction, and that's where your financer and your title company.
Okay, so let's try to recap this thing, Mike.
Okay.
So the preparation stage. Pre-approval.
Pre-approval. Get your money into the bank, save some money. You need at least some money for closing. It depends, but you need at least some money for the cost. You need to look at your credit score, okay? If you don't have any lines of credit, you need to open up. I'm not encouraging debt. That's
right.
Not great, because we do look at your debt-to-income ratio. If you have a lot of debt, even if you make a lot of money, you might not be able to qualify for a loan. That also, affects. But if you have no credit history, you got to have something. So just, one credit card, one purchase a month, pay off.
Yeah.
That does wonders for your credit score.
And a debit card does not qualify.
No, a debit card. Now here's another trick. Actually, I forgot to mention. Say you don't have any credit history or your credit score is not that great. Okay, maybe you have a family member, who's had a credit card for 20 years, never missed a payment. They can put you on their credit card, okay, and then once it reports to credit bureau, that's your account too.
Uh-huh.
So you have all that credit history. Now, say you don't trust me, okay, and I ask you to put, well, you could put me on your credit card. You don't have to give me one of those credit cards.
Uh-huh.
You're just helping me with the history.
Hey, Mike, but that's only good if their credit is good.
Well,
or they're paying their bills
on that one account.
Yes, exactly.
On that one account.
Exactly.
Yeah. So the way that gets risky is, say they mess up, then it can hurt you.
Right.
But I've had people come in before, and young people, and say, I don't have much history, and I pull up the credit score, and they've got a 780, and I'm like, and they're like, what? And I said, yeah, you have this credit card here for 20 years. They don't know.
Their parents.
Dad put them on a credit card several years, didn't tell them, and it built their credit for them.
Right. Okay. So, Mike, if one of the viewers are watching today and they want to get in contact with you, how can they get in contact with you? The business development manager.
One number's right there on that card. Why don't you read it out to us?
We're actually going to put it at the bottom of the screen.
Okay.
That way, I'm just messing with you. We're going to put it at the bottom of the screen and all of his information so that you can get in contact with Gateway Mortgage Corporation.
All right.
So listen, I want to thank Mike for coming today to share with us this great information about preparing yourself if you want to purchase a home when it comes down to mortgage companies. And so I want to thank you for coming in. I want to thank you for joining us today on what's happening in our neighborhood. And we will see you next time on our broadcast.